Global markets are stable ahead of US inflation figures later this week. Australian wages data today will be closely watched by the RBA. And India's inflation rate dips below 4%, although perhaps only temporarily due to a reduced tomato base effect. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of FX Research Marja bin Zaman says the dollar-yen exchange rate appears to have stabilised after a wild couple of weeks.
The Bank of Japan was seen as too hawkish at its July meeting, but in our view, the data that we have seen so far really validates its position.
But first in 5 and 5 with ANZ. Global stock markets are stable this morning ahead of an important week for US data, including July CPI inflation and retail sales. ANZ Head of G3 Economics, Brian Martin, says the stabilisation indicates recent anxiety that the US economy is headed to recession was overblown. Brian says he still expects the Fed to cut 25 basis points in September and says the markets have got ahead of themselves in pricing 100 basis points of cuts in 2024.
The Atlanta Fed GDP Now index is indicating growth running at around 3% on a seasonally adjusted annualised basis in Q3. The July Services ISM index rose 2.6 points, taking it back above 50. And the labour market, although hiring has slowed, is still expanding. It does appear to me that much of the 0.2% rise in the unemployment rate in the US in July to 4.3% reflected a 250,000 increase in temporary layoffs. So I think that is just adding to confidence that the Fed are on the right track.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was flat, the Aussie up 0.27% at 65.90 US cents, and the Kiwi up 0.37% at 60.20 US cents. Number 2, Australian wages figures for the June quarter are due later today and will be watched closely by the RBA and by markets trying to work out whether inflation is cooling enough to avoid another rate hike. ANZ Australia senior economist Catherine Birch is expecting quarterly growth of 0.9% and for annual wages growth to fall to 4% from 4.1% in the March quarter. That's quite a bit above the long-run averages and above levels seen in tune with low inflation.
There's a rule of thumb that if you want inflation to be hitting the midpoint of the RBA's 2 to 3% target band, so 2.5%, you can run wage growth at about 3.5% over the year, as long as productivity growth makes up that gap of 1%. But that's more of a longer-term view. In the near term, there is quite a bit more adjustment.
Number 3. The RBA will also be watching NAB business confidence figures for July, also due later today. A particular area of interest will be what businesses are saying about their costs and what they're doing with prices.
Now, they have been signalling disinflation, so inflation coming down, but they have been quite bumpy as well. And one thing to watch out for in the July release today will be on labour costs, because this will be measured for July, which is when the award wage increase is implemented. So they will likely pick up a bit.
Number 4. India's headline CPI inflation rate dipped below the Reserve Bank of India's 4% target midpoint in July, and that was slightly below the consensus forecast. ANZ economist Dheeraj Nim says that was down to the reversing out of last year's tomato price shock, which the RBI is likely to look through.
The kind of inflation configuration that is visible now, the food inflation is falling only gradually and core inflation is inching up and could possibly reach the 4% mark by March 2025, leaves the Reserve Bank of India a small window to recalibrate the policy rates, but not before the end of the year. So we do not expect the Reserve Bank of India to start cutting rates before December 2024. And even so, it would be a shallow rate cutting cycle, more like fine-tuning of the policy rate to the economic conditions.
Number 5. It's a big week in New Zealand with an on-edge monetary policy review on Wednesday. Before that, though, is June net migration data today, which ANZ New Zealand chief economist Sharon Zollner is watching to see if the weak monthly inflow in May is the start of a sharper positive turn.
Obviously, lower net migration is a negative for GDP, but in terms of inflation pressure, there's actually offsets because population growth contributes to both demand and supply. So the RBNZ's on record as saying, well, on balance, net migration is probably a small positive for inflation, but there's lots of uncertainty around that. So probably not a game changer for the RBNZ, but obviously for the overall GDP, it matters.
Sharon Zollner there. Now, in our bonus deep dive interview, ANZ Head of FX Research Marja bin Zaman recaps the wild ride that the US dollar-yen exchange rate has been on in recent weeks and why she thinks it's found a flaw in the short term.
We think that it has possibly found a floor in the near term at 152, which were the recent lows. Now, I think we need to look at the key drivers of yen's strength so far. And of course, since early July, it all started with the US July CPI, which started to moderate, which then firmed up expectations of a Fed rate cut in September. Then, of course, on the same day, we also had Ministry of Finance intervening. We obviously now have confirmation of. And then much later, coming to the end of last month, we saw Bank of Japan raising interest rates by 15 basis points and announcing a schedule of quantitative tightening, and also ending with hawkish forward guidance at its meeting. Now, to top all of that off, we then got US job market data. We had non-farm payrolls, which then showed signs of softening by high unemployment rate, which actually then drove US Treasury yields much lower and increased expectations of Fed rate cuts. I think it was really this element on the US side of things where yields moved significantly lower and rate cut expectations shot up that really triggered the huge move or the sharp move lower for dollar yen. Now, since touching a low of about 141 on the 5th of August last week, it has retraced a little bit, and we think this is on the back of a couple of key events. One, of course, the data post non-farm payrolls actually paints a not so negative scenario of the US growth story. We did see higher than expected US ISM services numbers, which then again point to a soft landing, not a hard landing scenario. We also had jobless claims, which came out lower than previous month and lower than previous week and lower than expectations. And of course, along the way, we had Japanese officials verbally intervene to somewhat stabilize the yen.
What happens if it falls again? Do you think authorities will intervene on the way down for US dollar yen as well? Because in this cycle, they have intervened on the way up.
So, of course, we've seen almost close to a 20 big figure move in dollar yen. And, when you look back in history, this hasn't happened many times before. It brings the question that on the way up for dollar yen, there was always something which we call the 10 yen rule, which means that, previous interventions within this cycle pointed to the fact that if dollar yen moves in a short period of time by a large amount, you would see intervention. So, of course, the way dollar yen has moved lower, the question arises, will the Japanese authorities also intervene on the way down? And look, in past instances, Japanese authorities have intervened to both not just weaken the yen, but strengthen the yen, and they are unlikely to welcome excessive moves in either direction. So I think, we need to be wary that on the way down, if there are significantly sharp falls ahead, I think that is something we need to be wary of, especially given that we have seen a lot of verbal rhetoric from the Ministry of Finance and Japanese authorities over the last couple of days, talking about FX and how it should reflect fundamentals.
What are your forecasts for the US dollar yen going into next year? And is the Bank of Japan going to hike again?
So overall, beyond this sharp move, the direction of dollar yen is tilted downwards. We do think this will be a slow and gradual move lower. We are looking at dollar yen to end 2025 at 136. But between now and then, I think there is two-way risk. Of course, the Bank of Japan was seen as too hawkish at its July meeting. But in our view, the data that we have seen so far really validates its position. We do expect the Bank of Japan to continue its tightening path with a rate hike in October. That's really on the back of, more recently, we have seen real wage growth turn positive for the first time since March 2022. Furthermore, minimum wages have recently risen. And of course, the impact of Shunto wage negotiations on consumption will be evident in Q4. But that said, we had the BOJ's July meeting summary of opinions, and within that, and also Deputy Governor Uchida's speech last week, which then highlighted that the Bank of Japan is determined to keep the pace of policy normalization gradual. So again, all in all, we are expecting to see more upward move in Japanese interest rates, which should then continue to see a downward move in dollar yen and a stronger yen going forward.
Najibeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, August the 13th. Catch you tomorrow with a preview of that On Edge Reserve Bank of New Zealand rate decision. It's live. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.